First of all, a very good afternoon to everyone. And on behalf of the Morningstar team, I'd like to welcome and thank you for attending this exclusive webinar. For those that I haven't met, my name is James Lowe, and I lead our business initiatives in the financial advice sector. Firstly, how we strategically partner with successful advisors, practices, and licensees who share our beliefs with an absolute focus on client centricity in how they serve and placing the end investor's needs above all else. Secondly, the teams that partner with these advice businesses to provide our solutions and services in a manner that not only aligns with best practices that we see from advice firms across the globe, but importantly for what is unique and makes sense for each firm and their advice process they follow. I know my team are absolutely delighted that you can all be here as we progress our webinar series for modern advice businesses in 2021. Just a big thank you to all of you on the positive feedback we received on our first webinar of the year a few weeks ago with Jodie Fitzgerald. It was never more topical than at the time. We had some great feedback, as I said, and I think what Jodie covered, she pretty conservatively and prudently described it as an opportunity of a decade when perhaps it was an opportunity of a generation. So for those of you that haven't had an opportunity to watch that, please do contact us and we'd love to share it. While that webinar was focused on our pillar of investment solutions, today's webinar is a great follow-up as it truly integrates the principles of the three pillars of best practices that we follow when we work with advice businesses. Firstly, investment solutions. Secondly, behavioral science and coaching. And then thirdly, practice optimization. Before I do a brief introduction into the purpose for today, just some housekeeping slides. Just please, today, everything you're going to hear is of a general in nature and does not take any account of anyone's personal circumstances. There will be an opportunity to ask questions. Please do use the Q&A function on Zoom. I know we've all been using Zoom extensively for the last year, but so hopefully you all know where that is. And then in terms of today's session, there will be CPD points, and we will obviously share those with you afterwards. So in terms of the purpose of today, as I said, it integrates the three pillars. This is really the first of a two-part goals-based advice and goals-based investment strategy alignment sessions. Today's one is really focused on the accumulation phase in goals-based advice. Now, when delivering goals-based advice, there are a number of things that as you as advisors focus on: lifelong cash flow modeling, values-based planning, what matters most about money to your clients, everything focused really on their needs and aspirations and what they want to achieve. And then you implement that quality financial strategy. That quality financial strategy is then given to specialists to implement: tax specialists, lawyers, insurance organizations for wealth protection, etc. A key aspect of that is investment strategy, which then is implemented with the purpose of achieving those clients' goals, needs, and aspirations. Now, just as there's some really high quality financial advisors delivering high quality financial strategy, similarly, there's some fantastic investment managers and investment portfolio construction taking place. Any reputable analysis will show that for an advisor, having an investment philosophy that is repeatable, evidence-based, and robust is absolutely key. However, the problem for an advisor that hasn't changed for decades is how do you align the high quality financial strategy you have implemented for your clients with the decisions being made on the investment being implemented for those clients? So irrespective of whether it's repeatable, irrespective of whether it's evidence-based, how can you ensure that what matters most to your clients is at the center of that framework when decisions are made? And that is what I'm excited to share with you today. Our thought leadership insights on an evidence-based investment approach for you to implement in your practice. This approach does place your clients' goals at the center of the framework and practically aligns goals-based advice and investment strategy. As joint fiduciaries on your clients' assets, there can be no better way to demonstrate you acting and making decisions in the best interest of your clients than doing that. So with that, I'd like to introduce you to Peter Burns. Peter is a senior sales executive at Morningstar and dedicated to working with advice practices who are looking to transition their businesses to implementing goals-based investment strategy. Peter has significant experience having worked across multiple disciplines in advice technology, advice process, and investments. So he's uniquely positioned to talk on the subject. He has also headed up services to licensees in the past and now works in his absolute passion in field with advice practices alongside them as they evolve their business to goals-based advice and investment strategy. There are very few people I've come across in my career who have a passion and understanding for this than Peter. To explain how following a contrarian valuation-driven investment approach is really that solid and most best interest way. So with that, I'll hand over to Peter, who will take you through today's session. Peter, I think you might be on mute.
Now I should be right.
Okay. You should be good. All good to go.
Thanks, James. Thanks, James. Welcome, everybody. It's great to see such healthy numbers joining us today. I just wanted to start by, I guess, clarifying exactly who or what part of Morningstar we represent. As most of you know, Morningstar is a major global research business. We're actually operating on the Morningstar investment management side of the business, which is just one of the divisions, but it's quite separate from the research, software, and data sides of the business. We have over 100 investment professionals managing multi-asset portfolios here in Australia. And those portfolios are outcomes based. And by that I mean they're a little different to a standard SAA based framework that you might be familiar with. And that leads itself to a different performance objective and a different definition of risk. The performance objective that we're aligning to is to beat inflation. So it's a CPI plus X, I guess you might say, and X is represented by the risk profile that you and your clients have determined is appropriate. Our definition of risk is not aligned to a variance around a mean or a standard deviation, which many SAA-based framed portfolios are. Our definition of risk is loss of capital, and particularly loss of capital which is difficult to recover from. And that's a really important point, and we're going to kind of focus on that and how that will help you achieve the outcomes that you're looking to achieve for your clients. So I guess to having framed who is Morningstar and what sort of portfolios we run, the next part is, why do we do what we do? Why do we build portfolios with this kind of outcomes approach? And how does that align to what you're trying to achieve on behalf of your clients? So that's kind of the preface of the question that we've posed. Let's get stuck into this. A good place to start is what it is exactly that you do. And I don't want to teach you how to suck eggs because I know you're all very good at what you do, but let's just sort of give ourselves a framework. So obviously, at the start of the relationship that you have with your clients, you do your fact finds, your risk profiles, etc., and you establish exactly what the client's trying to achieve. What are their goals? What are their aspirations? They'll be both short-term, medium-term, and long-term around retirement lifestyle. And then as we sort of, I guess, develop the relationship, we review their situation regularly. And all of the conversations, or 95% of the conversations we have with clients, we're kind of framing back to, how does this change in circumstance or this new bit of information, how does that impact on the goals that we've set? Do we need to tweak any of the goals? Do we need to reset timeframes, etc.? So goals are very much at the heart of what you're doing, and you're really trying to maximize the probability of clients achieving the goals that they've set. With this in mind, portfolios are just one of the strings in your bow or in your quiver, and they are never the end game. They should always be just a means to an end. But what I'd pose here at this point is, do the portfolios that you utilize actually fully align to the outcomes and goals that the client's trying to achieve? Are they best constructed and managed to help you meet that objective? Now, the goals are never aligned to beating a benchmark. The goals are never about, have I got the right index, or have I got the right level of diversification in my portfolio? The goals are always far more tangible, and they are, things like, I want to buy a property, I want to educate my kids, I want to be able to take that holiday, etc. Risk is often not talked about enough, and we're going to speak a lot about risk in this presentation. But I guess the real challenge that we're kind of trying to address here for you guys is that, have we got the right kind of fund manager, portfolio manager that will help you maximize the probability of clients achieving those goals? This is my Financial Planning 101 slide. And if we start on the left-hand side, it's, if you like, the start of the relationship with a client, and you sit down and you do the fact find. You determine what their assets and liabilities are, what their income and expenditure looks like, what sort of cash flows have we got, and what goals are we trying to achieve. And as I said, we've got a range of short and medium term goals. And then there's the largest of the goals is usually the retirement goal, which sets the client up for their lifestyle in retirement post their income generating years. And as the advisor, once you've established what their goals are, you'll set about, as James indicated, putting the right strategies, cash flow management, etc., in place, using the right tax structures, insurances. And as I said, the portfolio under this kind of a program is really just a means to an end. And what we want to do is show you how the type of portfolio that you decide is appropriate can have a very large impact on the likelihood of the client actually achieving goals. And one thing to point out here is it doesn't matter which of the goals we want to focus on, but hopefully you can see my mouse. I'm going to focus on the retirement goal just for a second. It's usually the largest of the goals. As we get closer and closer to the point where we're going to actually realize that goal, which in this case would be the date of retirement for the client, sequencing risk starts to rise. And sequencing risk, for those not familiar with it, is simply a term that refers to the risk that the market corrects dramatically at or near the point of achieving of that goal or the date of retirement. And it can have such an impact that it can forever change the lifestyle that the client may eventually have. It could defer retirement. In other words, we have to push back the date of retirement. And it could also have such an impact that goals are never really fully achieved and have to be totally reassessed. And what I'd put to you is that the typical portfolio that advisors have been utilizing, which are SAA-based, strategic asset allocation based, actually are part of the problem of managing sequencing risk, not part of the solution. SAA-based portfolios were never designed to help clients achieve outcomes. They were designed to meet the risk profile requirements of AFSLs. They were designed to meet a strategic asset allocation framework inherent in the risk profiles. And there lies the problem. Now, Morningstar Investment Management, this is sort of an admittance here, actually ran SAA-based portfolios up until the point of the global financial crisis. And at that point, we had a good hard look at the portfolios that we were running, the fiduciary responsibility that we held on behalf of your clients. And we came to the realization that these types of portfolios would never allow us to take risk off the table sufficient to protect investors' capital, nor would it ever allow us to pin our ears back and actually go after opportunities when markets corrected and real cheap opportunities or value opportunities presented themselves. So it's at that point, what are we now, 11 or 12 years ago, that the realization struck us that we needed to change the way we manage money. And at that point, we changed to this outcomes-based approach. So it's now got a very healthy 10 years of history. And it's this 10 years of history that we're really going to kind of dive into in the next little few minutes.
Peter,
so,
sorry, just one question. As you've sort of outlined the problem there, I suppose, from your perspective, how's the use, or should I say misuse, of risk tolerance questionnaires contributed to this problem you've created, if one looks in the last sort of 10, 20 years?
Yeah, if I'll answer it in an interesting way, James. If you go and look at all of the management of family office money, the really big end of town, and go and ask them if they operate in risk profiles, and they'll shake their head and they'll say, why would we ever do that? What possible rationale would there be for us to manage long-term monies based around some random strategic asset allocation? The reason risk profiles exist is because there are means to which AFSLs can actually protect themselves from the advisors that they license. Similarly, SAA-based portfolios are a risk management tool. And if you look at all of the portfolios that are out there, they will all basically provide you with the same kind of outcomes, all aligned to what the benchmarks do. And that old term of benchmark hugging has been very commonly referred to over the industry over the last 20 odd years. SAA-based portfolios are the antithesis, the absolute realization of that. So what I'd say to you is risk profiles, they are a great way to control advisors and keep advisors in a very narrow pathway, but at no point is the best interest of the clients ever considered in that framework. And so what we've done is tried to take that kind of open up that hood, look inside what is in the best interest of the end investor, and that's why we've come up with this outcomes-based approach. So I want to now take you into what an SAA-based framework looks like and compare that with what an outcomes-based framework looks like. On this slide, these little blue bars here, they are, I'll call them the long-term asset allocation of a growth portfolio. You see along the bottom here, we've got various asset classes. So we've got Australian shares, international shares, etc., all the way across to cash. So for Australian shares, this is off the Morningstar database. This is typically what the long-term anchor will be for a strategic asset allocation growth portfolio. So we'll have 22% in Australian shares, we'll have 33% in international shares, etc., all the way across. And then these little grey bars are the range that most SAA managers operate within. And so they're allowed to go up 5 from the long-term, or the LTAA, the long-term asset allocation. So they go from 22 to 27 in Australian shares. And if they don't like the asset class, they can get out of it or drop that allocation down as far as 17%. They can't go any broader than that. That is actually stated in their PDS, and they would be in breach if they did. Now, some managers in more recent times have expanded those ranges, but you won't see anything broader than 10% up and 10% down. They're generally 5 up, 5 down. Okay. Now, the first question you ask is, why would you do it? Well, I've answered that. It's a risk management opportunity. But the consequence of these narrow ranges is that if I like the asset class, I can dial it up, but I can only go as far as 27 in this case. If I don't like it, if I think it's expensive, I can dial it down. There is another consequence though, and that consequence is what the performance objective of the portfolio is. So let's consider Australian shares in isolation out of this entire growth portfolio. If I'm operating in that hamstrung framework, the performance objective for Australian shares could only be to beat the ASX 200 or maybe the ASX 300, depending on what the mandate prescribes. And so as I go across each of these, here I would be looking to outperform the MSCI, etc., all the way across. So therefore, the benchmark or the performance objective for this growth portfolio keeping in mind it's an SAA framework, would have to be to beat the weighted average of the indices in which I'm invested in. Now, what that effectively means is that the performance of the portfolio is heavily aligned to what the market does. If the markets go well, all's good, and these things will perform really well. If the markets go poorly, there's nothing that the portfolio manager can do really about that except take the losses that the market generates. And in fact, part of the underlying sort of acceptable premises within this is that losses are okay. I'm going to show you that losses aren't okay and losses should be avoided. And when we look at what you're trying to achieve for clients, that whole goals-based framework, you want to be maximizing the probability of clients achieving goals. This is not the right way to go. Now, the dark maroon bars here, or dark red bars, they are the asset class ranges that we operate within for our outcomes-based portfolios. So for Australian shares, we can go 0 to 60%, same with international. You can see all these wide ranges. Cash, really interestingly, we can go from, I'm not sure exactly what that number is, 2 to 3% through to 45% in cash. So if we think everything is looking very expensive, we can dial down, protect capital, and go to cash. Now, the fact that we can go to zero, you're not likely to ever, sort of actually go to zero. You're always going to find some opportunity within each of these major asset classes. But it's fair to say that if you think you need to protect capital at certain points in the market, like just prior to the GFC would be a good example, as we entered into the COVID lockdowns around the world might be another, you can actually dial down dramatically these more growthy or risky asset classes and dial up into asset classes that are either representing good value, or if you can't find enough of those, dial up your cash holdings. And I'll show you later exactly what we did during 2020. And we actually did exactly what I've just mentioned. We held a lot of cash going into the COVID crisis or the correction, and we deployed that cash as markets fell. Okay, so what you can instantly see here is that these wide asset class ranges allow us to protect capital, etc., but they have another really important function, and that is they allow us to change the performance objective from being one which is very market aligned to one which is inflation aligned. And so now we can actually change that performance objective and lessen the impact of the market on the outcome of the portfolio. And that can come on in sort of two areas. One is that area of, what is the absolute performance number that we're after, and also how much risk do we want to take in the portfolio, and therefore how much capital loss are we prepared to suffer. And we can manage losses far better under this kind of framework. Diagrammatically, this is sort of an easy way to think about these types of portfolios. These are your SAA-based portfolios, rather static in the asset allocation. This would be looking at your growth defensive split here. Here we're looking at a very much more dynamic approach, and we are very active in the asset class ranges that we operate within, but we do operate typically within your risk profiles from a growth defensive split. It's just important to kind of rationalize that, because we often get questions of how would this fit within a risk profile framework. It does so at the growth defensive level, not at the individual asset class level. Okay, so I just wanted to return to this and really talk about how these wide asset class ranges that we're now deploying can help you to manage this sequencing risk. As you've now sort of seen quite clearly, under an SAA-based framework, very, very difficult to manage sequencing risk. And in fact, traditionally, what advisors have done is they've moved clients down the risk profile as they've got nearer and nearer to retirement. And that wasn't a bad way of managing it. The problem was that once you hit retirement, if you've got a couple and they're both at, say, age 65 with relatively good health, there is a very, very high percentage probability that one of them will live to age 90. Now, that means you've still got 25 years to manage their money. And if you've now got them down the risk profile 2 or 3 sort of levels, and you've got them into a reasonably conservative portfolio, which was great. It protected them in those last few years and got them to their, hopefully to their, capital level that would give them the lifestyle in retirement. But remember, we've got 25 years to go now. And it's awkward, difficult to start advising clients that they need to go back up the risk profile again as they move into their retirement. I will say that Morningstar is going to be releasing some really interesting behavioral finance work that we've done on how to manage retirement portfolios for clients using bucketing strategies. Many of you will be using bucketing strategies. One of the tools that is going to be launched as part of this will be a set of rules, if you like, in how to tip between the buckets. When is the optimal time to tip between? And it'll also have a software tool that'll help the client understand that they're continuing to be on track. So keep your eye out over the next little while for the work that we're doing in this space. But to come back to outcomes-based portfolios and how they can help you manage the sequencing risk through this period, rather than take your clients down the risk profiles, internally within the portfolios, we have greater asset class ranges so we can help you manage the risk within those portfolios. You still might drop them down a level. That might make a lot of sense, but you certainly won't need to do as aggressively as you've done under an SAA framework in the past. So one of the great outcomes of this is not only that clients will have their risk managed better, but they can stay more fully invested through that period of getting close to and then entering retirement. It's incredibly powerful, and a lot of our clients they might take a more aggressive approach with their very young clients. They might even use index portfolios. But for those clients that are getting sort of 45 plus, they look at this type of arrangement in how we manage the portfolios from this outcomes-based wide asset class ranges, risk-aware process. And they're having a lot of success with their clients in explaining this to clients. So just something to think about. So these are really the three areas that you're going to be working with clients around when you're talking about portfolios. It's how much time have we got, how much risk can we take on, and what sort of return are we needing to take. And if I was to talk about risk profiling, as James kind of alluded to earlier, one of the things that we've done within Morningstar, again from our behavioral finance team, is do some work on the three elements of risk profiling. You've got tolerance, you've got capacity, but the one thing that often isn't taken into account is need. And so that leads to what performance, what CPI plus performance do we need to achieve the goals that we've got? And so again, there's another area that we'll be delving into in the next little while that you'll be able to avail yourselves of. So again, what this statement here on screen is really saying is that these outcome-based portfolios are incredibly strong contenders for the role that you're playing with clients in helping them achieve their goals, their lifestyle goals, etc. So I want to talk about losses for a minute and how important they are, particularly for the clients that you have where they've got large asset bases. They're obviously, in some cases, their super will be one of their largest asset. And there's been some great work done in recent years by Milliman, the actuaries. It's commonly recognised that most investors loathe losses at a rate of about twice what they appreciate gains. So, and that's kind of been, I think, widely accepted. What Milliman did in the last few years was did some research specifically on retirees, those people who have, left behind their income generating capabilities. Retirees actually loathe losses at a rate of 5 times what they appreciate in gains. So losses do matter. But I've got some stats for you just to sort of flesh this out a little bit for you. This is a chart that simply shows if you suffer certain losses, what is required to actually generate what return is required to get you back to square. So if I am in a portfolio that loses 20%, I would need to generate 25% in gains to get myself back to square. If you take that all the way out to a real correction in the market, a 50% correction, I would need to generate 100% to get my portfolio back to square. Downside protection matters in portfolios. Now, what about if we look at one of the drivers of future returns in portfolios is the price that you pay when you initially invest. And this is a fairly obvious statement, but we've actually done some work looking at the S&P 500, the US market, since 1891. This work was done in 2014. And we looked at, we divided the market up into quintiles. And we said, well, if you bought the very cheapest assets, which typically are the most unloved assets, if you were to buy only the cheapest assets, what's the maximum level of drawdown you would suffer over I'm not sure what the actual time frame is, but I'm going to say 5 years. And what it tells you is that by buying the cheapest assets, you suffer the lowest levels of drawdowns. You buy the most expensive assets, and by definition, you're going to suffer the highest drawdowns or losses in a portfolio. And I would call out some of the very highly priced IT and what do we call them? Term I'm looking for is referring to like Uber, Tesla, these types of disturbers in the marketplace, and some of the prices that are being paid for these types of companies at the moment, they may well be ripe for quite large corrections at some point. Conversely, this one looks at, well, what's the projected income, or the actual income, the real return over the following 10 years if you were to buy, again, the very cheapest and most unloved assets versus the most expensive over here in quintile 5. And you can see the difference in return going forward over the next 10 years is dramatic. So again, by focusing on value, making sure that you don't overpay for assets, you can minimize losses and maximize returns. And what we're doing at Morningstar is very much using this valuation approach combined with wide asset class ranges to manage risk and provide very consistent long-term returns for clients. Now,
sorry, Peter, there've been a couple, there've been a number of questions coming through. So just a big thank you to everyone. Keep sending them through, and we'll sort of be pulling them together. One of the questions that has come through, and knowing what you're going to be covering now, as you go through it, it'll be definitely worthwhile just touching on the timing, the timing of this. So just bear with me. I'm just getting the right. Is the ability to dial up or dial down risk dependent on one's ability to time the market, and usually executed at a point in time when the event has already occurred? So as you go through the next couple of slides, it'll be worthwhile reflecting on the timing question, because there've been a number of questions coming through on the whole timing aspect. So I'll leave it to you.
Yeah. One of the things which Morningstar does not try and do is predict macroeconomic events. So if in that question you're saying, are you able to therefore time the market? The answer is no. What we do, however, is look at what's in the price at any given point in time. Now, that does mean that you're always slightly behind, if you like. And I'd be more than happy to admit I would rather be, wait for the event to occur and then react to the price that drives, that is driven, than try and buy and predict, because we think that it's a bit of a fool's paradise to think that even if you could predict the outcome of COVID or the outcome of an election, etc., would that then lead you to an optimal investment decision? And the answer is usually no. And I'll point at the chart we've got on the screen here as a way in which to describe this, I think. So this horizontal line is our estimate of fair value. And we spend an enormous amount of time trying to evaluate using cash flows to determine what the fair value of an asset is. And the sine wave in this chart is the actual price of the market or of that asset at any given point in time. Now, when I said we spend a lot of time valuing assets, we actually value on a monthly basis over 300 asset classes, sectors, regions, currencies, etc. So we spend a lot of time doing this. And so we have a fairly good handle on what we think fair value is. We build in these two horizontal lines, either side of the pink one, are our margin of safety. You can't assume that all of your assumptions or timing is going to be 100% right. So you need to build in a layer of fact around your estimate of fair value. But having sort of arrived at this range around fair value, we look at what the price is doing, which is the sine wave, and let's assume the price sits up here. Now, at this point, sentiment towards this asset is positive, and that's driven the price up. Everybody is in and they're buying this asset. And most people would take the view, looking back at recent history, they would say that the risk in this asset is actually quite low at the moment. We would take a fairly contrarian view to that opinion, and we would say this asset now is above fair value. It's even above our margin of safety. The potential for future returns are now greatly diminished. We don't know where that top is, but we know that it's now already well above its fair value. And the potential for losses at this point are elevated, because even if it just returns back to its fair value, we'll lose if we buy that asset at that point. If we own this asset, this is the point in time where we'd be selling as everybody else is buying that asset. Conversely, if the market for that particular asset corrects, new news comes into the marketplace that people now rethink their assumptions. They now assume it's time to get out. This asset now falls well below its fair value. At this point, those who are looking at volatility as a measure of risk will say, wow, risk is really high in this asset right now. Sentiment is very low. There is obviously some negative news in the marketplace driving the price down. Everyone is selling down here. We would take the view at this point, this asset is now well below its fair value. It's outside our margin of safety. This is a buying opportunity. And it's a buying opportunity because the potential for future losses are now greatly reduced, but the potential for returns are now elevated. And if the market, as it often does, overshoots, as more positive news comes into the marketplace and away she goes, often it overshoots, great opportunity to sell at a nice profit. So that's our process in a nutshell. And it's easy to say, it's easy to talk about, and you would expect almost every fund manager will say, I want to buy quality businesses for less than they're worth. Everybody says that. But do they actually do it? Do they have a process in place that allows them to have that kind of discipline? Let's have a look at what happened in 2020 to actually flesh this out. This is the marketplace during 2020. It's the MSCI. And you can see positive January into February. We got to February 20th and the market woke up to the lockdowns, the dreadful situation that was, on our doorstep, which was COVID. And the market started to correct, and it corrected as quickly as we've ever seen. And it corrected over a period of about 25 days or so, a little bit longer, actually, about probably 33 days, I think it was. During that period, the market was taking on negative sentiment, taking on negative news around COVID, and everybody was selling out of this market. That's the only reason prices fall, is because people sell. So fund managers, individuals, the whole globe sold out of this market. Morningstar could see value opportunities appearing, and we traded through 8 separate days during that portfolio. And we bought heavily into global shares, in particular global energy, global financials, and we deployed what was high levels of cash. We had the highest levels of cash we've ever held in the portfolio as the market corrected through this period. Now, as the market got to the bottom, it hit a trampoline and it bounced. And it was actually the shortest bear market in history. And it literally came out of the blocks running. What we did, as opposed to what everybody else was doing, we started to de-risk the portfolio and we started to take profits. And you can see these red dots here were us taking profits. There was a mini correction through here, and we again rotated the portfolio even more heavily into the UK and global energy, and we continued to take profits all the way through. Incredibly contrarian. And so while everybody says we would be in there buying, we would be, taking advantage of lower prices, in actual fact, the globe doesn't, sentiment drives markets in the short term. It's very difficult to actually be the contrarian, the guy swimming against the tide, if you like. The outcome of a process like this, in a very simplified manner, looks like this. If this is what the market does, now this could be a growth portfolio or it could be the market. What we're trying to achieve, and we think we're doing actually really well, is we're actually trying to provide a much smoother glide path through the market noise that occurs from day to day, month to month, etc. Now, it's not to say that this process is the panacea for all evils. This process does come with some challenges, and it's particularly relevant for advisors. And Morningstar is very aware of this. And so we spend a lot of time communicating to our advisors about what is going on in the portfolios and giving you all the messages that you need to help clients stay invested. Now, what I'm really sort of most pointing at here is the period from here to here. In short-term areas of the market, you will find that our portfolio will underperform because at this point, we're buying up cheap assets. Here, we're selling out of expensive assets when everybody else down here has been fully invested all the way through. They're all SAA based, right? They suffered the big loss. So when we measure from here to here, which happens, at various times, you'll find in the short term, our portfolios might underperform unashamedly. So it's important because clients behaviorally will think, why am I missing out on this performance? They'll have forgotten that this fell so heavily in the first place, and they'll just look at that number and go, why aren't I getting that performance? So it's imperative that we provide you with a lot of information around what we're doing. We've been selling out of these expensive assets so that we won't fall, and what we don't want to see people do is move out of our portfolio at this point and buy into that portfolio at that point, which is the easiest way to lose capital long term. So if I showed you, and I'm going to show you some 7 and 10 year numbers I could have shown you some 1 and 2 year numbers in this example, and they would show you that we slightly underperformed in this period. But I'm not concerned about that. I've only got the 7 to 10 year numbers because at the end of the day, we do actually, this process will outperform peers by suffering lesser losses. You can see here, the maximum falls in our portfolios are less than peers. And our performance over longer term periods will actually outperform. So if we go back to our original kind of Peter Burns's Financial Planning 101 slide, this is where it's in this period here that we're really coming into our own. When clients have got multiple goals along the way, each one of these comes with sequencing risk. This particular goal in particular, we genuinely believe that an outcomes-based approach to investing will give your clients the best opportunity of achieving those goals. So you'll do all the tax strategies, you'll do all the cash flow, the savings regimes, etc. Let us look after the portfolios, and together we'll maximize the probability of clients getting those goals. We'll keep them invested because they won't suffer the large losses. Again, that works very much towards maximizing the probability. Now, lastly, I keep going to my keyboard when I should be going to my mouse. How can we support you? This is, if you like, a call to action. If you think that this type of approach could work for a percentage of your portfolio or of your clients, I'm sorry, how do you get started? Well, what I would suggest is that because we're Morningstar and we are one of the largest research houses on the globe with probably the largest global reach, we can analyze your portfolios and we can help you to understand what your portfolios would look like compared to an outcomes-based equivalent. And we can show you the risk inherent in the portfolio versus the return. We can show you what the drawdown looked like over time. We can even do asset allocation comparisons for you. The one thing we can't do, unless you've got the information, is provide what the amendments to the portfolio was over time. However, in most SAA-based frameworks, there is very little movement in those portfolios. So we can certainly give you a pretty good understanding. It's not a best interest analysis, but it's pretty close to. And we can also, if they're just retail fees arrangements, we can show you the fee comparisons as well. So to sort of sum this up, I would say that if what I've spoken about today, you think you would like to investigate a little bit further, a good place to start might be, let's have a look at your portfolios as they stand now, and we can give you a comparison to those. But we've also got a business development team that can come out and have a chat about how these portfolios might be implemented for clients and the way forward from there. So James, if you've got any more questions, I might wrap up this part of it and then we can take any questions.
Perfect. Yeah, we got heaps of questions. So again, thank you to everyone, and we'll go through those now. So you've left good time for those. Just the first question, Peter, if you could flick back through to slide 16 and 17. Good questions come through and said, do slides 16 and 17 hold true post the GFC, given the number of value traps being disrupted and going bust? I know that these slides, the way to almost look at these slides for everyone sort of going through the webinar is, this is the academic evidence, the evidence-based, this is not about an investment approach, but more about valuation and understanding the various quintiles that exist, and that evidence does hold true. However, be worthwhile, Peter, touching from your perspective, valuation is just one thing, but when you follow a really robust valuation-driven asset allocation framework, there's a lot more to it than just looking at value.
Yeah. It's so I think, James, you've answered the first part of it quite well, in that this is looking at the entire market. And so you will get some value traps in amongst that. You'll get the odd Kodak, coming through. And so in order to avoid putting the Kodaks of the world into your portfolios, you need to do the fundamental research. You need to understand the robustness of cash flows, the predictability of cash flows, and what Morningstar term, we use a term called moats. And what a moat looks at is, does a particular asset or business have a means by which it can protect its cash flows going forward? And they can be things like patents, they can be government regulation, they could be something like Facebook's interconnectivity or networking sort of advantage that they have, whereby it's very difficult to replicate that kind of business, and they have, incredible strength in that network that they've created. Other businesses have patents, like pharmaceutical companies, etc. Some have government regulations, the four or five pillars banking structure in Australia, etc. So there are ways in which, when you look at companies, you can determine the quality of those businesses to ensure that you, where possible, avoid value traps. But you've got to be aware of them.
Absolutely. It'd be worthwhile flicking back through to the, I think the evidence of being true to label slide. Questions come through here.
As in the trading slide?
No, keep going. The 7 and 10 year sort of evidence of approach slide.
Ah, that's back here.
Yeah, further down. So I wasn't sure which way you were going there. There
yeah,
we are.
Yeah.
There, but go there. So the question that's come through is, and I'll sort of touch an aspect of it, but I'll be keen to get your perspectives also. Following on from the timing question, can you take us through how these portfolios have behaved during the sell-off of last year and the subsequent rebound? Now, this question came in before you covered the trading and other things, but the one sort of comment I'll be sort of keen just to make here, I think, which is super important. If one looks at the drawdown, and this is where if you look at all the evidence and academic research into behavioral science, and investors make decisions, they're more likely to pull out of the portfolio at the worst possible time when they have lost capital more than others in the market. So for us, when you look at the 1 year or 2 year timeframes, it is absolutely key that drawdown is always less than the market. And as you said, Peter, it definitely is, because that is for us more important in the short term, whereas the longer term, it's more about the returns, to make sure that investors and advisors, for that matter, because we all suffer from behavioral finance biases, just make sure we don't pull out at the worst time. Is there any additional comment you can make on that? I'm not sure.
Look, I think the only other comment that I would make is that during the correction, when we were purchasing growth assets quite heavily, we were very selective in what we were buying. And for the first few months after the correction, where the market was very driven by particularly the FANGs, our portfolio did underperform through those first few months after. So really from about March through to sort of September, October, you had a period where if you were invested in the IT and the disruptors, and particularly the FANGs, they, were just off the charts, the returns that were being sort of generated. And in fact, the FANGs now represent 20% or more actually of the US market, and about 12% of the global market. And so you've got this insane concentration in those businesses. They're quality businesses, have no doubt. It's just, could you buy them at this price? The assumptions that need to be made around the prices that they're commanding, we just couldn't buy into. Having said that, the minute that the vaccines sort of rode over the horizon and looked like they were going to be implemented across the globe, sort of struck us in early November. And suddenly the assets that we'd bought as the market corrected, particularly global energy and financials, we were off to the races through November, and the portfolios produced outstanding results. And so what we're now seeing, and this is what Jodie Fitzgerald did in the last session, that we have enormous evidence that suggests that value investing will be the great beneficiary as the globe comes out of recession, and we start to see, some real positive news on the horizon. We started to see that in November. We expect to see more of that in the months and probably years ahead. And so we think we've got the portfolios incredibly well positioned to take advantage of that, with a little caveat that it will be a slightly more rockier road through this period than what we might normally expect to see out of our portfolios, because these kind of more cyclical stocks that we've bought into will be slightly more volatile. But yeah, there's a real spring in the step of our portfolio managers at the moment.
We got time for just got two questions I want to cover. One was actually more of a comment, which we can touch on secondly. But just the first one, we've had a number of questions come through surrounding managed accounts and whether this approach is applied to managed funds or direct shares or both. And it might be worthwhile, I know that that's a huge question and one that we'll go back to each of those individuals who asked the question and I'll post the session, but it might be worthwhile just clarifying just how this approach is applied in the managed account world at a vehicles, which vehicles are used and how that's done.
Yep. Yeah, we offer into the marketplace both managed funds, diversified managed funds, and diversified managed account portfolios. The exact same process and philosophy is applied whether you're in funds or managed accounts. The difference is at the implementation level. Within a managed account structure, because we are reliant on the platforms implementing the portfolios, and because of the nature of a managed account, we take advantage of the transparency and beneficial ownership advantages. So we have we have direct shares in the Australian equities and listed property sectors. We use ETFs in most of the other sectors. And we also have managed funds in our portfolios, which they go in at zero fee because we put our own wrapper around them. But some of those managed funds are actually fund of funds, where we've used some of our research capabilities to purchase fund managers that aren't normally available in the Australian marketplace. International bonds would be a good example of that. So the managed funds are very direct in the assets that they hold and are relatively non-transparent. The managed accounts, being extremely transparent, are a combination of those three levels: direct, ETFs, and managed funds. But the overarching philosophy, the attitude towards risk, the performance objectives are perfectly aligned.
Thanks, Peter. So we're at the top of the hour. So just to sort of conclude on today. So thank you again for the incredible questions that came through. We will, for those, go back to on those we haven't had an opportunity from time to answer. And then with a number of questions about slides, absolutely, we can share those slides with you and actually address those questions. In conclusion, I just want to say is that if what Peter's really covered is an approach which really has your clients' goals at the center of their framework and their lifestyle needs and aspirations. That's step one. Step two, and hopefully it's come through clearly, the absolute foundation of our values at Morningstar is investor first. Everything is about your client, that we act as joint fiduciaries with you for their assets entrusted to us. So making sure that the decisions that they make from a behavioral finance perspective is accounted for in all the decisions is also super important. I did mention at the front, and Peter did sort of touch on it during the presentation, is that really Peter's side has really covered what I refer to the accumulation side of things. And we will be having a sort of part two, which is really decumulation, the pension phase. How do you implement goals-based investment strategy with advice in that phase of your client's journey and wealth creation. So with that, there will be an invitation for that coming through shortly. We'd love you to join us for that one too. But thank you again for your time. We really appreciate it, and have a wonderful day.
Thanks, everybody.